So this next subject is one of those sort of foundational pieces. It's called the maximum utilization strategy, but I want to use this as an opportunity to really set stage for a number of things that are going to follow. And so we're going to talk about, funding your growth, because everybody here has a growth mindset in some form or fashion. And what I've come to realize, there's kind of two levels of growth for business owners. The first stage is the business owner that wants to go from the in to on mindset. So it's Crystal's, you want to go from chucking a truck to Pete with a fleet, right? That's kind of her wonderful example. The idea that I want to make that transition where on a day-to-day basis, I'm not on the tools. And that could be the chiropractor too, right? On a day-to-day basis, I'm not just seeing clients all day long, trading time for money. It's I'm building a business that pays me whether I'm actually physically doing the work or not. That's that first transition. That's hard. Right, Brian? That's hard. But then there's the second transition, and I experienced this myself. I went to a company called Cartel Communications in 2009 in Langley. Very successful business. When I got there, they had 5 years, flatlined, rough, but basically. And the guy before me that was running the sales team was no slouch. He went on to be the CEO of the Toronto Airport Authority. But he was more operationally focused. In my time there, we increased the revenues by over 30%. The owner wanted to take it through that next phase of growth because it had kind of gotten stagnant. So that's the second sort of stage of growth. But here's the big challenge for most small business owners. Do you grow to build or build to grow? Do you know what I mean? Do you know the difference? Okay. Can you right now, Andrea, can you hire 3 more people hoping 6 months from now they actually generate enough revenue to pay for themselves? Or do you have to have the revenue first and then hire the staff? Okay, that's the difference. Grow to build is you hire people hoping that they'll build your revenue. Build to grow is you got to build your revenue first to grow your team. And most small business owners, unless some guy, by the way, last night won one ticket won $58 million last night on 649. And most small business owners it wasn't us. Most small business owners don't have the capital wherewithal to just willy-nilly hire extra staff. Like, we know companies do it all the time. Think about how many extra drivers UPS, all the courier companies brought on board in the fall for the Christmas rush, right? Amazon hired tens of thousands of people, then they all lay them all off in the spring. Well, they don't lay those off. They keep the good ones and use that as a way to get rid of the ones they don't want. But you typically are going to have to finance your growth through your business revenue. So that's an important mindset. That's why the whole idea of maximum utilization is really critical. So we're going to talk about that. I'm going to give you some ideas on some financial metrics, and especially someone like David is absolutely welcome to chime in as an accountant and add some perspective if I've missed the mark a little bit. There, now there's a busy slide. But you're going to see this a few times and I'm going to use it. So the reality here is, let's just make some markers. Revenue, the blue line. Just straight up gross revenue. And then fixed costs is the red line. Fixed costs should be relatively stable month over month. That's why they're called fixed costs, which are different from variable costs. Variable costs are shown in orange, and they should scale as well relative to your total expenses. So total expenses are in gray, and then net profits in green. And so the whole idea here is your net profit is this little slice of green in the chart, but the key is your maximum utilization is here. So maximum utilization the way I describe it, not from an accounting, but from a business perspective, is you're absolutely maximizing all of the assets and resources you have in your business to drive the highest amount of revenue and the highest net profit. So you're getting absolute every bang for the buck possible in your business. And when we talk about the effective billing rate strategy later, I'm going to show you a couple of very clear examples of how you can do that, particularly related to your personal time and efforts in your business. Okay? So break even occurs, you can chart all this stuff. There's actually some math formulas if you really want to get into this stuff. But I just want to make sure we set the stage. David, are employee costs fixed costs or are they variable costs? Exactly. Right? That's one of those depends. I used to work for my whole sales career was typically in tech, IT, telecommunications, and a lot of engineering. Which was one company where whenever we asked an engineer a question, the answer was, it depends. Guess what I got the head of engineering for a Christmas present? A box of Depends. And we did it as fun. We were friends. But you got to be careful with this, because how you set up your books and how you track some of these numbers is really important. And sometimes programs like QuickBooks default in ways that probably aren't the best way to do things. So just be careful, and we're going to show you some of that in a minute. Okay, here's why this is important. An investor's going to look at this, and their question is, how quickly can I get a return? Is that not a big part of what you guys are dealing with over at CMC right now? Right? You're looking for investment capital, and all the investor cares about is how quickly do I get a return, whereas the owner, you're thinking as an owner, how can I get above break even to actually have a net profit? Right? You know, Jim Rohn, who many of you may or may not have heard of, he was kind of Tony Robbins' mentor in the old days. Jim had a great quote. When your output exceeds your income, your upkeep becomes your downfall. When you're spending more than you're making, you're in trouble. And here's what's scary. I talk to a lot of business owners and I say, what was your revenue last month? Well, I don't know. What was your profit last month? I don't know. What do you know? Well, I paid my bills, so I think I'm fine. Is that really a good answer? No, it's a terrible answer. You should know this stuff. Okay, let's talk about gross profit. This is a bit of a complicated slide, but I hope it makes sense to you. Let's say that you build a product. We talk about HVAC, Avatar HVAC. So they sell a furnace. And just as a frame of reference, let's say the brand new furnace installed is $5,000. Right? 20% of that is gross profit. 80% of that are just the costs, the variable costs associated with buying and installing the furnace system. But your business has other costs. It has fixed costs. Tristan talked about this earlier. You know, you could have leases, you could have truck rentals, you've got your business insurance. Those are all fixed costs that you've got to pay for. And so what happens in this circumstance is you have to sell 1, 2, 3, 4, 5, 6 furnaces, and the 20% or $1,000 profit on each, gross profit, all it does is that blue covers your fixed costs. If you want to have a net profit, you got to sell 2 more, because it takes these 6 to cover your fixed costs. The 2 more actually give you real net profit. Are you following me, or am I getting things? I'm trying to keep it simple, but you got to remember that if just because you sell a furnace for $1,000 profit doesn't mean you really do have a true $1,000 profit. That's a gross profit. It's not a net profit. And again, net profit is what matters. It's not what you make, it's what you keep. Brian, you've been doing, you do profit first, but you also, the Poly B stuff, right? Those can be fairly lucrative individual contracts.
I have to do 3 a month to get to net profit.
Exactly. See? He's got to do 3 fairly large jobs a month doing Poly B plumbing replacements just to have a net. So you got to always know in your business, what are these numbers, because they ultimately drive. I mean, Jennifer, can you tell me how many people do you have to serve in your restaurant a month just to break even with average margins, gross margins?
No, not that.
Because at some point, you get above covering all of your fixed costs. Okay, so if we're good so far, gross versus net. This is hard to read, but you're going to see this. This is a really, really important. The next two slides, this blows people away. How many of you are in a business where the only thing that matters is price? I'm glad I'm not seeing any hands. Price is important. Value is what matters. And if you're in a business where the only conversation you're having is about price, you could be having the wrong conversation with the wrong person. You don't want to be in a business where it's a race to the bottom because nobody wins. Nobody wins. But I want to show you these next two graphs. They're really powerful in understanding the impact dropping your prices has. So let's make an assumption. So right now, our margin is 35%. If your present margin is 20, 25, 30, I've put 35 in a box, okay? If you increase your price by 10%, you actually end up, you could let your sales drop by 22% to make the same gross profit. So increasing your price is 10%, you can lose 22% of your customers and still have the same gross profit. Most people don't think like that. But here's the scary one. 35% gross margin, what if we decrease our price by 10%? We have to increase our sales by 40% to make up for that. So if you get these charts and you know what your margins are and you start playing around with your prices, people don't think, I'll just give people 10% off. It won't have an impact on my business. Oh my God, it has a huge impact on your real numbers. It can cost, you got to increase your sales by 40% to make up for that.